What's up guys, Duracell Dave here from the trading community Art of Aping. Just want to spend a couple minutes right now to talk about how to trade news events. This is a hypothetical to a thesis that I've been looking at for quite some time now, but as most people know, today there was an FOMC meeting where Powell spoke about another hike, a Fed hike by 0.75%. And so a lot of times people during this day want to sit on the sidelines because there's a lot of volatility in the market. Rightfully so, it's probably best to just make sure that you don't get wrecked, especially if you're using leverage, get stopped out, or get liquidated. But something that I've been looking at and noticing is historically what happens during a big meeting, whether it's a CPI meeting or again, it's an FOMC meeting. And so if you take a look at my charts right now, I'm just showing you the last 3 meetings that have happened throughout September. And I want you to notice something. At the very beginning, most people, when they're trying to pick the direction of a trade with FOMC, they're trying to pick the direction of the trade from where price is currently, right here. So as an example, this was at 18,900 for Bitcoin. Something that I'm noticing is that during FOMC, regardless of which direction, what they like to do is they like to take out a local high and a local low. And so what I've been testing out now, and we'll go through this very briefly, what I've been testing out is actually setting limit longs and limit shorts just above and below the local highs. And so for this specific FOMC meeting on September 21st, let's pull this up real quick. At this point in time before the meeting, you would not be able to guess which direction price was going to go. However, if you just looked at the local high and the local low, which was right here, it doesn't really matter what comes first in this scenario. If you're sitting in front of your computer, you would have caught a trade with a really, really good risk to reward ratio. Price would have popped up, and I would have taken this one personally. It looks like they've gone a little bit higher, but my stop loss was in a safe zone. And then they come down and they target this low, in which case now I've entered into a long position. And I'm noticing even more so that after they've taken out the low or the high, then they end up gravitating towards the direction that they originally had the impulse at. So it took a couple days, right? You can see though that price actually went back up. Now, ironically, there was another meeting about 6 days later. Same thing happens though. Now what they've done is they've gone and they've taken out this high up here, and it looks like they didn't take out this low. They took out a local low right here. And so there's some calibration that you have to do yourself. But also what you could be doing, because there's such high risk to reward trades, is you could be layering in multiple positions, and it's okay if you get stopped out. So you could actually have, one position as a long right here at this local low. Could have created another long right here, expecting price to come down and take out the lows from the last FOMC meeting. And this one wouldn't have triggered, right? But nonetheless, if you're just trying to catch a volatile move, I really think that this strategy does have some legs. If you look at today's FOMC meeting, right before that on September 30th, another core PCE price index meeting actually happened here. So they tried to attack a low, but didn't quite get it. So your order probably wouldn't have gotten filled there. And up here, they just went to fill a fair value gap. So you'll have to test where you actually want your entries to be, and if you want it to be a safe trade and actually just like book 1R, or if you're really going to try and shoot for 3 to 5 risk to reward ratio, that's up to you. But I just wanted to put this on your radar. Instead of trying to figure out where price is going to go the second the meeting starts, up or down, why don't you just identify where the target is up, where the target is down, and then set your orders there. Lastly, we'll just take a look at what's going on right now. This was the FOMC meeting. So I actually had orders set here and an order set here, and then I had another one set based off of like a gap that was created almost a month ago that was up here. Pay no mind to the actual stop losses. I set stop losses at around 21.7, and then I was targeting all the way down to here. Now, I grossly underestimated the range of the move. This range in terms of price from 28 to 21.5, you're looking at $650 move in a matter of minutes. But if you were to have set your short at the top of this with a stop loss above here, targeting that, and set your long here, targeting that, you would have been able to, with proper management, with actually sitting at your computer, you would have been able to book a win. So I hope that helps.